Tick, tick, tick. Is the debt bomb exploding? What's up, everybody? Welcome aboard to Bubba's Bottom Line. Always great to be with you here on the weekends. And of course, the question does remain, is the debt bomb getting ready to explode? And I think that the answer to the question is it's going to explode. The question is when, and we're starting to see a lot of things in these markets that don't look so good. Like that? In the meantime, here's what we have going on right now. You've got interest rates are charging quickly. All this out of nowhere, which is the way markets work. Out of nowhere, we've got interest rates 10-year at 7-year highs. We've got the 30-year at, I think, 5-year highs. You've got a key number we just surpassed in the long bond, the 30-year bond, at 3.3%. So what's going to happen to all of these debt that are out there that are based on these very cheap interest rates? Interest rates, they are rising, as we have talked about for months, that they were going to start to take off and that the bond traders were going to take off without the Fed, because the Fed, of course, is clueless. That is always the case when you let somebody try to work strictly off of academia and has no clue of what's going on in the real world. So as we look at what's going on right now, we've got a debt problem that is continuing to grow. We have, first of all, the United States. Last year we paid, I believe, $523 billion in just interest just to service the debt. Now, again, that was based on much lower rates. So as the rates tick up, so does the interest payments. So eventually those interest payments are going to be unpayable, where we will not be able to service the debt without more Fed intervention. It's going to create a mess. Now, again, there's no telling exactly when that's going to happen, but we've already started to see some weakness in the markets. And again, you have the pundits continue to push the theory that this time is different, that you just got to keep buying the markets, because what do we have starting this week? We have got the overall third quarter earnings starting to kick in on Friday, starting with the banks once again. Now, you know, my personal opinion on the banks is that they should not be too big to fail. They should have never been bailed out in the first place, and that they're lending out more than they actually have in reserve. In my opinion, this is an opinion, they are bending the rules of what they're supposed to have. I don't care about what these stress tests tell me. I don't care about what everybody wants to say about how strong the banks are. I see them in the same position that they were in each and every time these markets have collapsed. And I do not think this time is different. And I do not think that they've taken the proper precaution, okay, because we allow too much of the shadow banking system. And I'm telling you, there's certain things that I do know, and I can see that they are lending far more, in my opinion, that they have in reserve. So they are, you know, when the banks are lending money, they are actually, in effect, creating or printing new money, okay? Because when you can lend out 10 times what you have, supposedly in reserve, you are creating more money into the system. And if you're lending out more than that, then you're really creating a problem. But as we go back to look at the earnings picture, okay, I do not disagree that the economy has been humming along. I do not disagree that we have created a lot of new jobs. I think finally you're going to have now the market, okay, the job market, where there are more jobs needed. There's more employers than there are employees, okay? So there's more. So now no longer does the employer have the right to tell the employee to either work harder or we'll get someone to replace you. That is now changing once again, which is the balance of power. It's like any other market. You know, employees, work, business is the same market as a stock market or a bond market or any other free trade market. It comes back down to a price discovery model. And for years, the employers held the upper hand because there was not enough jobs. Well, now, all of a sudden, we have an overabundance of jobs, which means that now to get quality help, quality talent, you're going to have to pay for it. So what's going to happen here is the pay scale is going to start to rise. When you pay somebody more money, that comes right off the bottom line of your profit. So yes, third quarter profits will probably be very good, but I will bet that forecasts going forward will not be as robust as everybody expects them to be, because now we're going to have to pay more money. So if you hire somebody, we'll use a simple number, at $25,000 a year, it's not just $25,000 off the bottom line per employee. It's the benefits, it's the FICA tax, it's all the other things that go along. So 25,000 cuts, let's say 50,000 off of a payroll, okay, off of the bottom line of profit. Now, if we take into consideration that jobs are going to start to pay more money, which they're going to have to if they want to get help. Look, you're seeing, I think some of the McDonald's now are paying almost $15 an hour. So somehow magically, we've basically gotten up to that $15 an hour level that everybody was on the left was whining for, that they wanted the government to intercede into. And of course, what did we find out? That the free market system will work for itself and somehow prices will get up there. So in this case, wages have gotten up there. So we're seeing better wages. I think Walmart's at about 12. So we're seeing wages rise, okay, which is going to come right to the profit, right to the bottom line. Now, we also take that many of these companies took advantage of the cheap money, okay? So the cheap money that was out there is no longer so cheap. So if your loans are going to start to escalate, and we've seen that as we talked about through LIBOR, the London interbank lending rate from London, we've seen our rates start to go higher, and the 10-year now, I think 3.22. Okay, and again, you know that our black swan event will start probably at a 3.5 10-year with a dollar at about 97. Right now, it's a 3.2 10-year with a dollar at about 95. So we've got some room to go there. But again, here's another thing that comes right off the bottom line. When you were used to paying $100 a month for your servicing of your debt, now you're paying $120 a month or $150. That again becomes profit right off the bottom line. So although I expect to see good earnings, okay, and again, I'm still not a total believer in everything that's going on, but I do believe in what the president is trying to do, and I do believe that things are better for many. So that's a good thing, and wages are higher, so that's a good thing. We've still got to solve the healthcare problem, but all of these things now are going to take away and take from the bottom line. So we talk about inflation. So now wage inflation is not so bad because that means we need more help. But look at what's going on in oil. Okay, we're getting a major push up on oil. Now again, to me, this is a fear trade. This is more of a manipulation trade through many of the, through OPEC and through Saudi Arabia, through all the other things. I think we're seeing this happen. And again, I would firmly expect that oil prices will break. As you know, we mentioned, if you don't catch during the weekly updates, we puked out our oil and took our bath and said, okay, we'll look for another entry. But again, these are things that many of the prices of things that get out there, especially some of these asset classes, get manipulated around by some of the big commercials, by some of the banks. You know, we hear these big stories of you got to buy, you got to buy, you got to buy. We're going to, 100, whatever number you want to say that we're going to. And then, of course, they're really selling underneath the surface. And I think we're seeing a lot of these issues start to play within the market. But so we go back to the original thought that corporate profits are going to start to lower. Okay, you've got too much debt, so the debt bomb is starting to get ready. And of course, that then ties back into the equity markets. Because think about it from this way. I just got a note, for example, from Schwab about margin. Most investors in right now that have been coming in lately have been what we said retail trade. Okay, that's the small guys. The bigger guys, the commercial trade has been selling into this market. And how do you know that? Well, you can see stocks are making more new lows every day than new highs. Nobody wants to talk about this. The pundits, they don't want to be involved with all this. They can only talk about the good news, and all they want to do is trap you into getting your money into the market. I watch these, I watch and listen, daily, and of course I continue to hear this, oh, we're never going down again, this time is different. The whole story, it's really quite nauseating to listen to these guys talk, because these are the same guys that were telling you in 2008 that the markets were never going down again, and the same guys in 2001. And when you look at all of this great euphoric information, okay, consumer confidence, 18-year highs. Every number across the board is 10 to 18-year highs. Well, just go back and look at the clock to see what happens and know that history repeats itself, okay? Again, we don't predict collapses. We just see what's going on in the market. And when we have far too much exuberance and you've got too many people using margin debt, margin is a debt that has to be paid back. So when you buy a stock or a commodity or anything on a margin, you're taking a loan to buy that, okay? Most people using margin will leverage that up, okay? Which means they'll borrow more than they can afford. And when you leverage, okay, for example, just to go back to the Lehman Brothers Bear Stearns deal, they were leveraged at about 38 to 40 to 1. So every dollar that it went against them, they were losing $40. So if the average margin borrower right now is leveraging up 3 or 4 to 1, let's say, they don't have the $5 for the dollar it may go down. So they're going to be forced to sell out of this market. So not only do you have a group of people that do not want to be in this market and didn't want to be in, but now maybe they have some hope to get out, some of the fixed income, a lot of people that would prefer to be in safer asset classes that have less volatility are now going to have an excuse to get out of the markets. Everybody says they're not going to do it. Well, you just watch. We'll see, okay? But I've been doing this long enough to know that a lot of those people will be out. You get to 3.5%, they'll be yanking that money out because 3.5% is no longer 2%. Then you take the margin, okay, which will also create selling. So there's a lot of reasons to believe that these markets have peaked. There are a lot of reasons to believe that we are starting to see some tops in these markets. And I think that's something that is interesting to talk to. And of course, we've still got things to talk about the trade war and other things. But what we will do is we're going to step out here for a break. This is Bubba's Bottom Line. Todd Bubba Horwitz. Step out here for a break, and we'll be back with more after the break with Bubba's Bottom Line. We'll be right back. What's up, everybody? Hey, remember, if you'd like to help us with our high school investing program, we're trying to get this thing back on track and get it going at full bore again. And it takes a lot of capital to run it. If you'd like to help us continue to help high school students and help our youth of America with our financial investing and financial literacy programs, please go to Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. And you can help us out because we're trying, again, it is a big project to run and the schools pay nothing. We do everything right through here. So if you'd like to help us out, please go to patreon.com/Bubba Trading. And also don't forget to catch the Bubba Show every day from 4 to 5 Eastern at libertytalk.fm. And you can hear some great guys like Adam Barata from Advantage Gold and see what he's got to say. In the meantime, let's get back to Bubba's Bottom Line. Welcome back to Bubba's Bottom Line. Todd Bubba Horwitz with you. And of course, last week in markets we had, markets were under pretty heavy pressure. You saw early in the week they tried to rally. Now, we are now willing to say that we believe that the tops of the markets are in. Now, that does not immediately mean that the markets start going right into a major sell-off, okay? Again, this is one thing you have to remember. It's one thing to identify a potential bottom or a potential top. In this case, we've recognized or we think that we've found the top of the market, okay? And that's only for now. We still have the same opinion that markets do go up 8% year over year, just not every year. But we are now, as we mentioned earlier today, you've got lower highs, less new highs being made, more new lows. That's not a bullish sign. Much more complacency in the markets. Okay, many more people saying that this time is different. These are all warning signs. Okay, everybody ignoring the potential of what's going to happen with earnings and going forward. And we saw a pretty drastic beatdown last week. Now the Dow has remained the strongest of all the indexes. Okay, typically, that is not a bullish sign. Okay, the Dow is not a bullish index. The Dow is more of a safety play, dividend paying, risk off type of trade. S&P was weak and closed at the bottom end of its range of consolidation. Now, I would expect to see a little bit of a rally, but right now, we will be looking to sell into those rallies. Right now, I would be a seller. I'm going to be a seller at 29.20 in the S&P. But I think the big story was the weakness in the NASDAQ, and boy, did it get pounded late in the week, okay? But bigger than the NASDAQ was the pounding of the Russell. I mean, that was the beating of the drum. The Russell got absolutely clobbered each and every day last week and virtually had no opportunity to rally. Now, that's American companies. And what is the message that that's sending you? Well, I think the first message that's sending you is that it has nothing to do with the trade wars, because the American companies, the Russell does not deal in usually in a lot of export and things like that. So here we've got, let's say the American index, which is a great bellwether, getting hammered. Okay, well, that's telling you that these guys are preparing for higher wages that they're going to have to pay, higher cost to borrow money, all these other things. So bang, here you go. You see a big onslaught of getting pounded. So we're saying, now again, I would expect very early this week, I would not be surprised as a rally. Tomorrow is the Columbus Day holiday, which markets are kind of half open, kind of half not open, right? It's got, you've got, some of the banks are closed, but they're in, from the old pit days, which we know there's very little pits left, no bonds, no currencies, those products, but the equity market and the other markets are open. Banks are partially closed, so it makes it for a quirky day, which would be a perfect day to see a little bit of a rally, which we expect. We expect a rally, but we're going to be looking for an opportunity to sell into that rally. That is our look at it right now. We think the equities have topped. We are looking for some good opportunities to sell because I think this is going to be the elevator down here. But again, we remember, as volatility picks up, and if you take a look at, if you follow implied volatility, the S&P, the SPY volatility has not been this high for quite a while. So take a look at it if you watched it. So in the meantime, we expect to see some wild action, which means that you could see some very big down days, but there will be many dead cat bounce rallies that will be sharp and look so good. That's what we're looking for, and that's what we want to sell into when we get there. In the meantime, the grain markets look really good. They looked really solid last week, as they have now rallied the last couple of weeks, and we're now getting back up to those levels. 370 in corn, wheat's a little bit weaker, but 525 in wheat, and 860, 870 in soybeans. Look for $9 in soybeans. Look for we're looking for $4 in corn. First, we'd like to see 380, but looking for $4 in corn, and we're looking for a 6 handle on wheat. But I think those are now we're starting to see what we've kind of talked about as our thesis. A, they were oversold to begin with. You had too many short sellers on top of them trying to play the news cycle. And I'll always tell you this, the news cycle is BS when it comes to trading. Most of that's already been priced in. So you've seen a lot of pressure trying to push these grains down, yet they haven't really collapsed. They were down, they were ugly, but they haven't collapsed. And subsequently, they've come back and rallied back up again. So that's just telling you that how much more bad news are they going to price into this market? So we would look for a very big market. Now tie in the equities starting to sell off. And if we are right on equities that they're at the top, that money flowing out is going to be looking for alternatives. And I think the great alternatives right now are going to be the commodity space, grains, livestock, cocoa, cotton, coffee, whatever. There's going to be money flowing into commodities. That's a natural place where money goes when it comes out of equities. The people that want safe go to banks. The people that want to stay invested in something will now be looking at the downtrodden, beaten down commodities. Look at cattle. Cattle has been just moving along very, very nicely and continues to go higher, okay? Pushing highs. So I think that looks great. And hogs, as we talked about, when October hogs were in the 40s, okay, we said you got to be a buyer. They're either at or very near the low. They're now at almost 70. Okay, now they're going to come off the board here, but in the meantime, you're going to have December, which is in the 50s. So again, love the ag space, love the whole complex, looking to be buyers in there. And I think there's another big story developing right now, and that's gold. Gold has been beaten down to oblivion. Now, it found its base at 1180, although it did print 1167 overnight, but we'll look at 1180 is where it closed above, and we think that that looked great. But what's coming out now is that the hedge funds are carrying record short positions, like it's going to zero. And again, you can base this on all the things you want. The overall short positions are so huge, it's incredible. While as the commercials, which are usually and historically are net short, they're net long right now, which is telling you that this market's getting ready to pop and getting to bounce at some point here. And I would certainly be looking to be long gold. Now again, I'm not saying to jump in tomorrow, But use that 1180 to 1220. If we break above 1220, I think we're probably going back over 1300, maybe to 1400 in this next move. Once we break out, and again, that can still take an extended period of time, but there's a lot of underlying signs that look to be very positive. And we're now starting to see silver breakout, okay, which we've talked about before. We talked about that silver-gold ratio. Silver looks great. I think you want to look, again, these are investments. They're not for quick-term trades. If you're looking for something, I think you want to look into the silver market as well. I think when you also want to look into the crypto world. Cryptos have held up very well, and all of a sudden, out of nowhere, now Fidelity's involved. But of course, I don't think it's out of nowhere. I want to be very clear about this. You know, the big investment firms, okay, the big players, they always have a little bit of an agenda, okay? And I would like to see their books. Of course, it's like trying to audit the Fed. But I think they've probably been involved long before we hear about it today, okay? I think that goes for all of them. And I think that if we could look deep inside their books, they've been actually playing the game, which is why we might have seen such suppression in price for so long, because they're trying to get themselves into the business, because God forbid they shouldn't make money on one of these, on the cryptocurrencies. So you've now got Fidelity getting involved. So all of a sudden we're getting acceptance. You've got JP Morgan involved, you got Goldman Sachs involved, you got Fidelity, and who knows who else. Obviously, I'm sure there's a lot of others that are involved in this space. So I think they look very good. So the thing I think for you to look for this week, it's going to be kind of a short week because tomorrow's a little bit of holiday. I look for bond futures to have a little bit of a rally, but you want to sell that. Again, interest rates in my eyes are going higher, much higher, okay? I would not be surprised to see a 4% 10-year before the year's over. So you want to watch the interest rate, and that will create the pressure in the market. I think you want to look to be sellers of equities in general. You know, you can think you're prepared for the next crisis, okay? Now, people that work through my hedging program are 100% prepared for the next big meltdown, which is great. In fact, I get emails every day whenever markets go down, how happy they are because they're hedged and because they understand that they get to buy more stock. Because our goal is to be able to buy more when the markets go down, okay? Not get out and puke it out, but to actually buy more. But in the meantime, so I think you look for this, but this is, again, we never want you to be puke for the next crisis, but I want you to be prepared for the next crisis. And being prepared is not trying to figure out to roll from, you know, the risk on to the risk off trade. That's just a commission generator. That's not an actual strategy. It's something that's been, you know, used for years, but I want you to be very careful. You're better off, if you've got good solid holdings, you're better off just holding what you have instead of trying to time out the market. Traders can try to time the market because they're entering in and out of the market, okay? Investors should never try to time the market. It's a bad strategy for an investor, okay? That will be my words of you today. But again, I think U.S. home prices have hit a peak, which really is creating more unaffordability in the home world. It's harder and harder for people to buy homes. Now, you know, most people, and we've talked about this in the past, but most people, their biggest asset they own is their home. And the home is very sensitive to interest rates. So today, let's say the value of my home today is $500,000 with interest rates at 3%. Well, my home at 4%, my home's not going to be worth $500,000. So my assets are going to be declining because of the way this has all to do with the cluelessness of the Federal Reserve and the way that they've created this whole rate model, because my assets are dependent on the interest rate market. Okay, so obviously, if I've got to pay more for the house, I can't pay as much for, you know, the big house. So the only time you ever really cash out of the house is when you sell it and you don't replace it. So that's really something that should be a problem, and it's going to be, you know, something that you'll look into for renters. Okay, and I think that's, you know, again, we haven't really talked about the trade wars today, but as we've now seen, Mexico in, Canada in, EU will be next. There's Fed governors that are warning that this will create the next Cold War. And I just want to say that's bunk, okay? To me, it's a crock, and it's only a way to continue to try to manipulate the system, okay? This is Bubba's Bottom Line. I am Todd Bubba Horwitz. We're going to step out of break and come back with my commentary. How about commentary? And talk a little bit about Kavanaugh and Soros and some of the other crap that goes on. Bubba's Bottom Line. We'll be right back with more after the break. Well, we're having a great time today and enjoying discussing everything with you, and like to mention you to remind about our high school investing program. Again, we're just trying to help educate America's youth. For 9 years, I have funded it totally myself. Never charged a dime to the school, never had any sponsorship. Obviously, if you'd like to sponsor it, that'd be even better, but what we're trying to do is help educate our youth with some financial literacy, and it's our high school investing program. If you'd like to help us out, you can go to Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. In the meantime, don't forget to catch the Bubba Show every single day from 4 to 5 Eastern at LibertyTalk.fm. And we're going to step back and get back to Bubba's Bottom Line right now. Here we go. Welcome back to Bubba's Bottom Line. Todd Bubba Horwitz with you. And of course, as you know, every week I give out my commentary. And of course, this week we had finally the confirmation of Judge Kavanaugh and all of the nonsense that went through with all of that. And I think, again, I do not deny the fact that something might have happened to Blasey Ford. However, as I did a little bit of research and I did some other things, I want to know how come nothing ever came forward since she had this discovery of what had gone wrong with her. But as it also turns out that she is part of an anti-Trump team, also involved a little bit with George Soros, and that's more what I want to talk about in this commentary here. I think it's a real tragedy for Americans that when you have somebody who has as much money and who's as powerful as George Soros trying to manipulate the system that we have, trying to buy the system, when you pay for protesters. I think that, look, we live in a free country, which is the greatest thing we can have. We have Americans, we're free. We're allowed to have free speech. We're allowed to do as we want. We're allowed to do things within the law that are great. But I want to understand how anybody can support a person like Soros who wants to pay protesters to get in your face and to start harassing you, because why don't they get a job, okay? Instead of trying to create a civil war or a revolutionary war within inside this country, all because they don't like that Donald Trump, President Donald Trump, has taken away their ability to scarf the system, okay? What I want to know is why are we allowing these people with that power to go out and take away our freedoms? You think that you're supporting somebody who's supporting your freedom. You're not. You're supporting somebody who's trying to destroy your freedom, okay? When you allow people to come in and confront people and to try to muscle them and shame them and push them around to get them away from their beliefs, you have taken away the free life system. You've taken away what we all know as Americans is that we have our rights, okay? But yet you've got people that continue to try to pay protesters, okay, to put you in a position, and if you ever kick back or start back at one of these protesters who gets up in your face, you're the one who faces legal claims, okay? You don't have the unlimited bankroll. So now you've got Soros and others like him that have created this entire mess, okay, that's trying to create this far left socialism platform, okay, that cannot work, okay? Look at Venezuela. Look at any other place that has tried this socialism platform. It only benefits those at the top, okay? Look at Maduro. Look at all of those. Look at all the tops of the food chain. They end up with all the money. They end up with everything. And what do you end up with? Nothing. Looking for a place to buy toilet, looking for a piece of toilet paper. It's totally ridiculous. I think this whole left thing was a sham. And again, I am not against the Democrats. I am not against Republicans. I'm personally a libertarian. I think I should be in the middle, and I liked it better when everybody was more towards the middle. You can have ideas that are out one way or the other, but when it comes down to it, we should all be somewhere near the middle, making decisions not on whether or not we should fund the whole world, which cannot be done because, again, anytime you get into a socialist platform that only benefits the top, okay? Go back and read The Creature from Jekyll Island. You will see that this is almost a game plan that has been put in place by the extremely wealthy. Why else would George Soros be paying these protesters to do these things to other Americans? Okay, when did we become so divided? Okay, this happens, and of course, I believe that that's going to lead not to a blue wave in November. I think it's going to lead to the red wave. I think that this is a key tactical error that's of somebody trying to use his money and power to take over because he doesn't like that we're actually getting into more of a free market system. We're getting away from the company payroll. We're getting away from giving everything away so that the rich can continue to get richer, and we're actually trying to see somebody, a president, that's trying to bring more equality, which has created more jobs, more money, and more opportunity. That's the way I see it. This is Todd Bubba Horwitz, Bubba's Bottom Line. Have a great weekend, everybody. Thank you so much for being here. And of course, I always have to make a selection. Tonight's football game, the Dallas Cowboys against the Houston Texans. We're going to take the Texans and lay the 3. Have a great day. Have a great weekend. As always, I thank you. Bubba's Bottom Line.